Okay, thank you very much for having me here and giving me a chance to read that interesting paper. So the official name of my institution is Institute of Political Studies, but if you're in Paris and you ask where it is, nobody will know. The nickname that everybody uses is Sciences Po. It's the same place. So as everybody knows here, standard international macro goes as follows. It's perfectly possible to have autonomous monetary policies in the world of free capital flows if exchange rates are flexible. So in the context of rupee dollar that we have here, if the interest rate differentials between the RBI and the Fed widens, then the rupee will appreciate vis-a-vis dollar, and this will import deflation. This will make the domestic producers in India less competitive, and this goes exactly in the direction that the RBI wanted, which is easing inflationary pressure. That's what I've been teaching this term again. But what we started seeing actually before the crisis with some spectacular episodes of destabilizing carry trades in small open economies. I mean, best known examples are New Zealand and Iceland, but there are many others. And more spectacularly with the monetary spillovers that took place after 2008, now people have revisited this proposition. The view is that as an interest rate differential opens up, there's another effect, which is that the inflows create credit booms, asset prices booms that may go in the opposite direction from the one that the central bank that increased the interest rate wanted. It seems plausible that in some cases, at least empirically, this effect that goes in the wrong direction more than offsets, at least in the short run, the effect that goes in a good direction. And moreover, these flows are unstable in the sense that they can reverse in a fashion that's hard to predict and that's highly nonlinear. So these facts have been documented systematically by Hélène Ray in 2013 in a paper that's very famous now that she gave at Jackson Hole. And allow me to mention a paper that's much, much less famous, but that took me a very long time to publish. That's on the theory of this. That's a theoretical model in which this destabilizing monetary spillover can arise in a new Keynesian version of a small open economy. So, but this paper takes as given, in a sense, the model as simply as possible, but that's perfectly fine. Takes as given these destabilizing flows that arise in India, and the goal is, given these flows with a given distribution, how should we coordinate the two well-known types of public interventions that the RBI can avail itself of to manage them? So there are two types of policies that are studied. First, ex-ante policies are basically macroprudential policies that regulate either the price of the short-term foreign debt issued by a local institution through taxes, Pigovian taxes, or directly their quantities. And the other intervention that has to be coordinated with that is ex-post intervention, just direct intervention to support the rupee in foreign exchange market. And so there are three important results in the paper. The first one, most important, I think, is that these two instruments are complements. The marginal effectiveness of each of them increases as you deploy the other more. And I think that's particularly interesting because I think it's true that in some policy circles, and these instruments are still viewed as substitutes. So I think that's one thing, to not view them as complements, but viewing them as substitutes, whereas this analysis makes it, I think, ex post pretty obvious that they're complements. So I like this result very much. The second result is also a complement story, or a regulatory arbitrage story, if you want, that's saying that just controlling foreign short-term, the quantity or price of foreign short-term debt issued by domestic borrowers is not enough, because, well, when the public sector gives rights, like here, rights puts on the exchange rate, and duties, here the duties are taxes and foreign debt, there are always clever people who try to benefit from the rights without having the duties, okay? And here the clever people are non-resident lenders who lend in rupees, but they're still the same people, so there will still be states of the world in which they want to consume dollar, and the currency in which they lent was irrelevant, because they'll still try to sell rupees to get dollars at this point. And so that's a nice remark that this regulatory arbitrage can be important in practice. That's why the RBI did something about it after the tantrum. And the third part of the paper is really a very applied policy part that's interesting too. It analyzes, in the light of the theory developed by the authors, what was prevailing before the taper tantrum in India, and how India has amended its toolkits for external stability following the taper tantrum. And everything is well in line with the theory. So I don't know what the reverse causality is, if you first talked a lot to RBI and wrote the theory, or, but that's nice. So what's the mechanism for this complementarity between ex ante and ex post interventions? Well, as Arvind says, it's really fire sale externalities. Actually, it's really a basic common resource problem, right? If you put fishes in a lake, and if you let people fish without fishing licenses, they're gonna fish too much. Standard common resource problem. Here, each domestic borrower fails to internalize that when he issues dollar-denominated debt, it will consume, in times of crisis, the reserves of the central bank, thereby not making these reserves available for the other borrowers, and there will be, therefore, excess borrowing. And the complementarity comes from the fact that this more hazard problem is more important in some sense, the higher the reserves. The less you're worried about the exchange rate going very far down and making you very insolvent if foreign lenders want their money back, the more risk you take, and the more you siphoning out the dollar liquidity for the other people. Okay? So it's really a fishing problem. So you need to sell or ration fishing licenses. That's what the ex ante macroprudential policy is. It's a fishing license. By the way, the paper is kind of agnostic on, do you want to use price or quantity ex ante to regulate foreign debt? And I think that's I try to think about it. I don't have an obvious answer. That's an interesting question. All right, my comments. So first, it's mentioned a little bit in the paper, but I think it should be highlighted much more heavily. This complementarity, which I agree with Viral and Arvind, that I think it's a pretty new point in the international stability, external stability literature, but it's actually an old one in banking. Okay, so if you establish, you can establish a very accurate parallel between foreign exchange market intervention and lending of last resort. That's for ex post interventions, and for ex ante, well, controlling the price or quantity of foreign debt is the same as prudential requirement for banks in a closed economy. Actually, for banks, we use quantities, not price. We don't tax short-term deposits or short-term debt. Quite the opposite, we subsidize it, right? But we regulate quantity with all the Basel rules that you know, as well as me. And this complementarity is, I think, well known. There are many bank regulators who would tell you we have prudential requirements because we have lending of last resort. The regulatory arbitrage I mentioned earlier on, where clever people bypass the rules, try to benefit from the rights of the put on exchange rate, but bypass the rules by issuing rupee-denominated debt. Well, that's strongly reminiscent of what the shadow banking sector did before 2008, right? Let's benefit, at least implicitly, from all the guarantees from the government without being subject to prudential requirement. And you had liquidity siphoned away from the regulated sector to the shadow banking sector, very similar to what we had. So what I wanted to mention to Arvid and Viral is that the good news is that Emmanuel Farry and Jean Tirole have just released, like 1 or 2 weeks ago, a new paper on the coexistence of banking and shadow banking. That's a closed economies paper. But that's basically 60 pages of theory showing all the possible complementarities between the various types of regulation. So there are the 2 that you mentioned, but there's even more. There's also There are also things about liquidity sharing between countries and the role of CCPs. So I think that could be useful to discuss the action of the IMF or the swaps between central banks. But I think, yeah, that should be music to your ears, this paper, because they're pushing the complementarity story in a closed economy much further than it's been pushed so far. And so perhaps you could do the same thing in your international context. Okay, then I had two remarks about the model. So that's the kind of model that's meant to make the main point of the paper about complementarities in the simplest possible way. It's big success along this dimension. It's very easy to read. You see very clearly where the externalities come from just looking at two first-order conditions. So that's nice in that class of model, which I like very much. It's well done. I still think that there are some aspects that are a bit at odds with what we could expect in a macro international environment. And I think it would not be too costly to modify that a little bit. So that's suggestions, but maybe it's a taste issue. So first, I wanted to say something about my interpretation of the problem. And I wanted to say something else about exogenous exchange rates. So I didn't know how much you would detail the model, so I wanted to do that a little bit. But in the baseline model, with only foreign borrowing, you have a domestic borrower who has an exogenous technology. So big R is marginal productivity of capital in India, something like that, some technological return. And this domestic borrower has no choice, at least until you introduce foreign domestic borrowing, but issuing US dollar debt to fund the project. And so the only dimension along with there's a decision made, that's the size of the investment. So maybe it's true that some of the Indian borrowers who were tapping US dollar debt were constrained in rupee, that is, either they were issuing low rate US dollar debts or they would not carry out the project at all. But I think there's an alternative interpretation of the model in which R is not some marginal return on capital, but that's the rate at which you can borrow to fund a project. We don't need to know what this project is, what the return is. We just need to assume it's high enough. And it's the rate at which you can fund that type of project in rupees. And then the problem that faced by each borrower is not how much do I issue in dollar to invest in that technology, but it's to finance my given exogenous project, which fraction is financed in dollars, which fraction is financed in rupees at the rate R. To me, it's a more natural interpretation of the model. That doesn't change the math, but in that case, you can interpret, I mean, R being the prevailing domestic borrowing rate with a little stretch, you can interpret it as the RBI policy rate. So maybe you have more interesting comparative statics interpreting big R as the policy rate. Maybe you can get, well, it was not transparent in the model, but I didn't see what the role of the L0 was. And if you get rid of it, I mean, my interpretation, you should get rid of it, unless that's a monitoring cost, I don't know. I'm not really sure you needed it, but maybe I missed something. All right, my other point was on the exogenous exchange rate. So except for the state in which there's a crisis and the RBI intervenes, the exchange rate is exogenous, and in particular at date zero, the market doesn't care about what the RBI will do in the future. No matter what the amount of reserve is, the exchange rate is constant equals to 1. And relatedly, it means that the model has pretty arbitrary predictions on what the return on carry trades is. Especially with my interpretation that R is a deposit at an Indian bank, well, those domestic borrowers make profits that can be all over the place. So I don't think it's bad to assume that there's a profits on carry trades. It's contentious. I think half the finance profession thinks, yeah, these high returns, they're not really profits. Maybe it's a peso problem, or maybe they're weird risk premia. Half the profession thinks, no, that's truly money left on the table because foreign exchange markets are illiquid, et cetera, et cetera. But I think you don't need to take a stand on whether there's an excess return carry trades or not. I think there are very easy ways to kind of endogenize the initial exchange rate and to have a return carry trade. So I'll present you my model in 30 seconds, but it's even simpler than yours. So I still call big R the return on rupees and small r on dollars. I call ET the exchange rate quoted like Q at each date. As in the paper, I suppose that some random shocks plus the policy of the RBI is well anticipated by, I suppose it's well anticipated by agents. They have correct belief about the random date one exchange rate, and phi is the CDF of the exchange rate. And there's a cost from being insolvent. So sorry, I call it C, not beta like Q, but that's the cost of being insolvent. So then you have an expected return on carry trade, which is the expected appreciation, depreciation times the interest rate, minus the cost of dollar, minus the bankruptcy cost. And you could just say, well, in equilibrium, this return should be 0, so the initial exchange rate will just reach the value at which this is 0. And then you have an exchange rate that has the right property, because if you expect the central bank to trade more at date 1, that is phi to go down, because you have a shift in first order stochastic dominance, and E of E1 to go up, then E0 will increase, right? If people expect that the rupee will be more expensive tomorrow, then the rupee becomes more expensive today. And then any model that tells you that what drives E0 is the size of the carry trade, you'll have an equilibrium value of L, with any return on carry trades you want, but for example, 0. And I think that's just, I think all the externalities in the paper would be the same, but in a very cheap way, you could endogenize the exchange rate and not give the wrong impression that your model relies on big mispricing in foreign exchange markets. All right, thank you.
Thank you very much, Guillaume.